Good afternoon and welcome to the Wealth of Advice Market Update on Friday the 9th of October 2020. A lot seems to have happened in the last 2 weeks since we recorded our last updates. Donald Trump, possibly at the worst possible time for his election campaign, contracted coronavirus and he was in hospital last weekend before making a miraculous recovery and dancing up the White House steps on Monday evening. In the UK and Europe, the Brexit talks appear to be becoming more advanced. Certainly the news stories in the press of the mudslinging at each side has reduced, which suggests that they are in good dialogue and an agreement may be about to be brokered. Positive news has been coming through, albeit that we haven't really noticed it as much because of the talk about an imminent second lockdown or a new lockdown which will be phased in with green, amber and red. I don't know which part of the country we're going to fit in. Probably is not the good one because the infection rates in the north are a lot worse than what they are in the south. Some people are becoming more concerned and frustrated by what UK government are doing. The decisions seem to be not necessarily joined up or coherent with some things that they were saying in the previous weeks. But the positive news which is coming through, UK GDP grew by 2.1% in August. Some news channels this morning were saying that that's not as much as they were expecting and therefore it's a negative. But I would suggest that if you can get 2.1% GDP growth every month, the biggest recession in history will be over within a few months. That can only be a good thing. Part of the reason why August's figure of 2.1% might not have looked great was because July and June rebounded very, very well indeed. So 2.1% growth for 1 month I think is very positive. Let's see what those figures are in the coming months as more lockdown measures may be imposed and businesses may be restricted from trading as well. So it'll be interesting to see what will happen. Obviously, we're moving towards Christmas when the consumer does tend to spend more. So maybe any downturn in what you can spend in certain industries will be picked up from what you can spend planning for Christmas. UK house prices jumped by 7.3% as mortgage applications hit a 12-year high. So people are out there wanting to buy houses. People are wanting to move. That's got to be a good signal for the economy being in overall good shape. Yes, as I say, we will always err on the side of caution and say the furlough scheme coming to an end might see an increase in job losses. But those people who are in safe, secure jobs, those people who are able to move are certainly wanting to move now. And Boris Johnson has promised the generation rent will soon become the generation buy because he's going to try and improve access to low deposit mortgages for first-time buyers. We'll obviously wait and see what he comes up with in that. But overall, my take from the UK markets and the European markets over the last couple of weeks has generally been positive. The FTSE 100 today finished above 6,000. We're not quite back to the 6,200 level that we saw at the end of July going into August, but it's certainly positive from where it was over the last few weeks. So as you'll see later on in the presentation, the portfolios in general are on the up, which is good. In other news away from the UK and Europe, across in America, we're now less than 4 weeks away from their general election. We're at the point of their election campaign where we've been having the presidential debates and the vice presidents having their debates. That happened on Tuesday of this week. There's nothing I like about that. It just looks like a cat fight. They're just slagging each other off, interrupting each other. It didn't look good at all. But behind all of that, obviously Donald Trump has had coronavirus. He left hospital on Monday evening. He then said on Tuesday that he wasn't going to support the US fiscal stimulus package until after he'd won the election. Markets fell immediately that night. I don't know if anyone was aware of that. By 8:30, I think it was Wednesday evening, the US market had gone from being 2% up on the day to -1%. It was a big shift in the space of 15-20 minutes, all because of him sending one tweet. So we're going to see more of that over the coming weeks. The US election, as I say, less than 4 weeks away. I'm starting to read more and more about how markets might react if either side was either to get re-elected or the Biden Democrat party were to win. There was a news story again which came out earlier on this week which was overlooked because of everything else that was going on. A Democratic-led report from the Senate in America came out on Wednesday and said your big technology companies, Facebook, Amazon, have got too much of a control. They've got a monopoly on the market. And one of the fears, if the Democrats win, they will try and break up these huge organizations. One of the examples was they said Facebook took over Instagram a year or two ago. That shouldn't have been allowed to go through because it's given Facebook too much influence in that whole social media sector. So it's worth keeping an eye on that. So when clients are looking at their portfolios, the best performing areas of those portfolios over the last year has been anything that's invested in US companies and US stocks that invest in these technology stocks. And if the Democrats get in and they decide to break that up, then that could be a negative impact on those funds going forward. So it's not all clear cut that if Donald Trump and his crazy tweets stop happening, if he's no longer president, the markets might calm down. It might be the opposite. There was also a report which said Mr. Biden might not like to deal with the UK because of things that Boris has said. Boris being friends with Trump in the past. So definitely going to be an interesting couple of weeks. On our next update in a fortnight's time, we will focus a little bit more on the American election. We're going to talk to a particular fund manager who's got a big influence over in America and get some information from them. So we now come to that part of the presentation where we look at the risk score 2 and risk score 3 performance of a notional £100,000 that was invested on the 18th of February, just before the pandemic hit and the markets collapsed, all the way up to the 7th of October. And I'm pleased to say after almost 8 months, the risk score 3 portfolio now got back above £100,000. The risk score 2 portfolio, which is slightly less in the stock market, is still £600 short of reaching the £100,000, but we're there for the risk score 3 portfolio. So it shows that when markets collapse, it's not a permanent thing. Markets recover. We've seen, as you can see on the yellow and the blue line on that graph there, that it isn't a straight line back up. There's peaks and troughs, there's ups and downs along the way. But as I say, for the risk score 3 portfolio to get back above par where it was earlier on in the year, we think that's a good place to be. Clients who are coming in, getting annual reviews now, are investing in this portfolio, are seeing that the overall growth over the last 12 months is now between 3.5% to 4% over that period. So again, positive for those people. The risk score 2 portfolio again has done just almost as comparable over that period, but because it doesn't have as much in the stock market, a little bit more cautious, then it is a little bit behind, which is what you would expect. The next graph looks at how world markets have performed since January. Again, we can see the FTSE 100 languishing behind both the US market and the MSCI World Index, which is a collective of all of the main world stock markets put together. If you'd put £100 into a FTSE 100 fund at the beginning of the year, it's now worth 81 quid. American fund, you're up to about £110 almost, and something that invests across the entire planet, £106.33. Why is the FTSE 100 languishing behind? Again, as we said before, lots of banks, lots of oil stocks on there. Will it improve towards the end of the year? Well, you would hope that if Brexit was done and we got a deal and everything was positive, the FTSE 100 should rise rapidly. Flip side of that is a lot of the FTSE 100 companies get a lot of their earnings overseas. So if the pound was to strengthen, the value of those overseas earnings would look a little bit less. So whilst people might want to buy the market, the companies themselves might not look as favourable. So you might not see that sudden bounce straight away, but I would certainly expect that to come back over the months, maybe a year, 18 months, because there's no getting away from the fact that since we voted to leave the European Union in 2016, the UK market has languished behind the rest of the world markets massively because of that fear to invest in us. So it's reassuring to know that most of our client portfolios are not fully focused on investing in the FTSE 100. It's a broad spread of UK stocks that we invest people into. The following graph looks a bit busy, however, it's all in the right order, you'll be pleased to know. It's the Wealth of Advice risk score portfolios since January till the year to date, up till the middle of October. Here we are now. As you can see, the risk score 5 portfolio, which has the most in stocks and shares, has outperformed the risk score 4, which has outperformed the risk score 3, and so on and so on. This is what you would expect. Earlier on in the year, it got a little bit crossed over where some of the more cautious portfolios were outperforming the riskier ones, when the riskier ones had fell the furthest. But as it's shown, good investment theory, the longer time period you're investing, the riskier funds should outperform the more cautious funds because the stocks and shares in those portfolios will see them through. And as I say, every one of those portfolios being positive year to date is definitely positive for our clients who are investing in those. We now look at the Royal London portfolio's performance year to date. Again, over the last couple of weeks, the performance again is continuing to rise. Good performance. However, the Royal London portfolios being more cautious than the other ones we mentioned. They're still in negative territory year to date. We're not that far away from them getting back above where they need to be. Trevor Greetham, who manages these portfolios, is confident he's got them invested in the right place. And he believes as well that if we do get a positive Brexit deal in the next couple of weeks, that all of these portfolios will rise. They do have a large exposure to UK government gilts, UK corporate bonds and UK stocks. So hopefully, as I say, Boris and his team can get the deal that they're looking for from the Europeans, and you'll see these portfolios rise over the next few weeks. So the next time we do an update, they will hopefully be in positive territory for the year. So thanks for listening again. Hopefully this week's update has been a bit positive. I certainly feel that we're now getting to the point of the year where markets are understanding and reacting to what's gone on in the past. Obviously, we're entering a time now with the American election coming up and the potential other lockdowns that are happening across our country in the coming weeks, which might be a bit worrying. We are keeping an eye on things. We are speaking with more fund managers again next week. And hopefully, as I say, when we do this update again, we have more positive news to bring in. So thanks for listening and goodbye.